welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Lumen Technologies Inc., ticker symbol LUMN. We're looking at Lumen today because the company's trading at its 52-week low. They're paying out a 15% dividend yield right now, and because the company's stock price is down significantly recently as the market has reacted to Lumen bringing in a new CEO. We'll be looking at Lumen's fundamentals to help determine if the business potentially looks undervalued or not. So currently, Lumen Technologies is trading for $6.66 per share. Over the last year, their stock price is down 47.5%. Over 5 years, their stock is down almost 2/3, down 19% compounded annually. Over 10 years, it's also pretty rough for Lumen. Their stock price is down 82%. And going back prior to the global financial crisis, their stock price is also down 80%. Be aware that this return in their stock price does not include the dividends that the company has been paying out. Again, currently they have a 15% dividend yield, which is one of the highest in the overall market, especially very high for a business that's been established like Lumen is. So in absolute terms, returns to shareholders have not nearly been this bad. So again, Lumen is trading just 30 cents over their 52-week low, which is down nearly $8 from their 52-week high. They have a ton of short interest around the business, with nearly 14% of their shares outstanding currently sold short. And even though the company only has a little under a $7 billion market cap, they have about a $35 billion enterprise value. For background about the company, with over 450,000 route miles of fiber, including 35,000 route miles of subsea fiber connecting Europe, Asia, and Latin America, Lumen Technologies is one of the United States' largest telecommunication carriers serving global enterprises. Its merger with Level 3 further shifted the company's operations toward businesses, which comprise of over 70% of their revenue, and away from their legacy consumer businesses. Lumen offers businesses a full menu of communication services, providing co-location and data center services, data transportation, and end-user phone and internet service. On the consumer side, Lumen provides broadband and phone service across 37 states, where it has nearly 4.5 million broadband customers. The company was formerly known as CenturyLink Inc. and changed its name to Lumen Technologies in September of 2020. Lumen Technologies Inc. was incorporated in 1968 and is headquartered in Monroe, Louisiana. So for our fundamental analysis today, we're performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Lumen based off their business fundamentals. So this analysis is going to continue to improve and evolve over time. It's still a work in progress, and it's an opportunity to learn in public. With that said, let's get right into our analysis. Starting off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. The reasons for this are that the average publicly listed business earns about a 7% return on capital, and because over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. So by asking for 14% average returns on capital here, we can potentially build in some margin of safety for ourselves based off of the overall quality of the business. For Lumen, while they have been increasing their returns on capital throughout this time, their returns even currently are just a little bit above average. Over their last 12 months, they produced about 9% return on capital, and averaged out, they're only earning about a 6.6% return on capital, so pretty much just about average there. So well below the 14% mark we were looking for. This is going to be an X to start off on metric number 1. For metric number 2, here we're taking a high-level overview of the cash coming into the business. We want their revenues, earnings, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So Lumen has been able to grow their total revenues from about $17.5 billion to about $20 billion. Their net incomes are also up over this time, as are their cash flows. It looked like 2017 was an atypical year for their cash flows, but they're producing pretty solid cash flows after that. So all 3 of these are going to be up. This is going to be our first check on metric number 2. Metric number 3, here we're taking the perspective of an individual shareholder in the business. By looking at the business on a per share basis, we want to see earnings per share growth over the last 5 years. And even though their earnings are up over this time, their earnings per share are actually down. This comes from the denominator increasing in this earnings per share equation. So over the last 5 years, Lumen has significantly increased their shares outstanding. They've diluted existing shareholders by nearly 64%, which is quite a bit of shareholder dilution there. Without digging into the business in too much detail, it's likely that some of this dilution at least came through their acquisitions. So you would want to do the further research to understand if those acquisitions were value acquisitive for the company or not. However, with that big shareholder dilution, their earnings grew at a slower pace than their shares outstanding grew, and so their earnings per share are down over this time. This is an X on metric number 3. It's important to look at their shares outstanding here because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business dilutes existing shareholders by issuing new shares, they're decreasing your ownership percentage in the business, which is ultimately going to decrease the percentage of the business's profits that you're entitled to. So even though Lumen grew their profits over this time, your percentage of those profits as an individual shareholder has gone down. And so far through our first 3 metrics, we only have one check. Metric number 4 is very similar. Here we're looking for 5-year free cash flow per share growth. So again, even with taking into account their dilution, Lumen has grown their free cash flows at a rate that's faster than they've diluted shareholders. So this one is actually going to be up here for a check on metric number 4. Over this time, they've increased their cash flows per share by nearly 2.5 times. And so far through 4 metrics, we are split evenly, 2 checks and 2 X's. Next up for metric number 5, here we're evaluating how the company utilizes leverage. We want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that they produced over the past 5 years. So relative to their market cap, Lumen has a lot of debt. This is not out of the ordinary for a telecom company, especially an enterprise fiber company. However, we just want to check that their free cash flows are able to support this debt load because ultimately we don't want to be investing in companies that are too overly levered, as during economic downturns, it's overly levered businesses, especially with ones that have debt profiles which mature sooner than later, that are going to be at the greatest risk for poor outcomes. So Lumen ended last year with $30 billion in net debt. They've been paying this down, and currently they have $28 billion in net debt. However, over this time, they've only produced $14 billion in free cash flow. So based on their abilities to produce free cash flows compared to their net debt, it looks like the company is still pretty highly levered and overly levered for our tastes. To get a deeper understanding and a more nuanced perspective here, ideally you'd really want to read through their 10K to understand how this debt is structured and when it matures in more depth. So this is going to be an X on metric number 5. For our 6th and final metric, the big metric of them all, we want their average free cash flows to their enterprise value to give us a yield above 5%. If this is the case, this will give us a slight risk premium to the risk-free rate of the 10-year treasury and potentially give us a reason to be interested in the company. So we're using their total enterprise value here rather than their market cap because total enterprise value is going to take into account both their net debt position and their market cap together and give us a more accurate economic picture of the business, similar to as if Lumen was a private company. So currently, Lumen has a $35 billion total enterprise value, and we learned that over the last 5 years, they produced $14 billion of free cash flow, which means that they're producing about $2.8 billion of free cash flow in a given year. So when we divide their $2.8 billion of average free cash flows by their $35 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of about 8%. That's nearly twice the yield of where the 10-year treasury is at right now, and that's solidly above the 5% we were looking for. So this is going to be a check here on metric number 6. Even taking into account their debt, outside of that, it looks like there's not a lot being priced into this company as a contribution from their market cap. So this is a potentially attractive cash flow yield here, and it just reinforces the need to understand how Lumen's debt is structured in more detail and to understand how the business has been issuing shares. So yes, the company looks attractive. You just want to dig into the company's track record for capital allocation and learn more about that going forward here. It's also worth mentioning that over their last 12 months, Lumen has produced $3.2 billion of free cash flow, which is above where this has been historically. That means that their current free cash flow to enterprise value yield, if we divide that $3.2 billion of their last 12 months of free cash flow by their total enterprise value, gives us a yield that's a little over 9%. So that looks attractive too, and currently they're even doing better than they have historically. So just another reason to potentially want to do more homework into this business. So as mentioned, Lumen is currently paying out a 15% dividend yield, which is very, very high for an established business. However, people make mistakes all the time by blindly chasing dividend yields, so it's important to stop and look at the fundamentals that underlie a company's dividends. So for businesses, we either want their dividends to be supported by their cash flows or their earnings, depending on the type of business. For Lumen, we're looking at their cash flows here. So looking at their dividend profile, it looks like Lumen's been able to support their dividends pretty comfortably in 4 out of these last 5 years. 2017 was the only year that was off here, but the company has significantly increased their cash flow since then. Over the last 12 months, this is more of the same. Free cash flow is really the lifeblood of any business, and it can be used to buy back shares, pay down debt, make acquisitions, reinvest back in the business, or pay dividends. So while it does look like they're not using a lot of their free cash flows and they're using a reasonable amount to pay dividends, management's decision for how they're allocating their cash flows is ultimately going to depend on the opportunity cost of how their debt is structured and potentially what would be a more attractive use of their capital. So while it does look like their dividends are well supported by their cash flows, the way they're allocating this may change whether they decide to pay back additional debt or even repurchase shares if they're thinking that the business looks attractive right now. And so again, while it looks like they're in good shape here, their use of cash flows have the potential to change into the future, although it's likely that they'd still be returning quite a bit of this to shareholders. Then finally, here we're using a discounted cash flow model to come to a potential fair value for Lumen. So starting with their current free cash flows and then projecting those out over the next 20 years based off their historical abilities to grow their cash flows, using both a growth stage over the next 10 years with a growth rate where the company actually shrinks by 4.5% annually, and then using a terminal stage over the 10 years out after that where the company's abilities to produce free cash flows decline at a rate of 6% annually. Then adding in their tangible book value today, which is pretty negative because of the debt that the company has. If you wanted a 12% rate of return going forward from Lumen from today's prices, it looks like a fair value for the business would be about $7.16 per share. So that actually does give some margin of safety from where the company's stock price is at currently. However, there are some big caveats to this. One is that a discounted cash flow model, just like any other model across any other discipline, is very dependent on its inputs for what it's going to determine as outputs. We're using inputs based off of Lumen's abilities to grow their free cash flows historically, but you need to do the work here to learn for yourself whether these are truly applicable for Lumen going forward into the future. 2 is that this rate of return would be including their dividends. So with a 15% dividend yield currently, it looks like their stock price would actually be declining by about 3% annually from where it's at right now. And then 3, this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, Lumen checks the box on 3 out of 6 of our metrics. They're only earning about average returns on capital. Over the last 5 years, the company's revenues, earnings, and free cash flows have grown. However, it's a mixed bag when we're looking at these on a per share basis, as the company has diluted existing shareholders by 64% over this time. Some of this dilution is likely coming from some acquisitions that the company did. However, you'd really want to dig into their 10Ks to understand that more. Then the business, even as a telecom business, looks like it's using a lot of leverage relative to their free cash flows. Again, you'd want to understand how the company's debt is structured and when it matures to have a better perspective on that. Based on the ability for Lumen to produce free cash flows, it actually does look like on both an average and a current basis that their free cash flows to their enterprise value gives a potentially attractive yield, especially relative to the 10-year treasury. And so that's one reason to be interested in the business, even with all of the debt that they have. Then Lumen is paying out a massive dividend yield of 15%. And while they've been able to support that dividend pretty comfortably with their cash flows, if the business does look like it's undervalued, especially with a new CEO coming in, then it does look like management would potentially at least have the option of redirecting those cash flows to do what would be in the best interest of shareholders, be that paying dividends, paying down their debt, or using those to buy back shares. Any of those 3 options would likely be value additive to shareholders and would probably be good choices. With the situation the company's in right now financially, it would probably be a pretty poor use of capital to either reinvest back into the business to grow it at just average rates of return, or even worse, to make some sort of acquisition and farther deteriorate either their balance sheet or dilute existing shareholders. So hopefully management is able to stay rational in their approach to capital allocation. Then performing a discounted cash flow analysis of Lumen based off of their historical abilities to grow their free cash flows, which are assumptions that you need to verify for yourself whether those are going to be applicable as a baseline estimate going forward for Lumen into the future. Then it looks like from today's prices, you could reasonably expect about a 12% rate of return going forward from Lumen. However, that would be including their 15% dividend yield that they're paying out currently. So it doesn't look like their stock price would be doing too much over the next 20 years if that analysis was applicable. To reiterate, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. Instead, it serves as a beginning and holistic understanding of Lumen to help you determine whether it's worth your time to dig in and learn more about the business. Before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. If you're interested in learning more about Lumen, I'd recommend starting with their corporate filings. You can read through their 10-Ks to get a sense of the history and the operating results from the business. Management will also lay out some of the potential risks that Lumen faces, and you'll get a deeper sense of both the environment that Lumen operates in, how management is thinking of the company going forward, and a sense of both the character and competence of management, especially when it comes to capital allocation. Through this deeper research, you'll learn more about both the qualitative and the quantitative aspects of Lumen Technologies. And as a value investor, you want to conduct your research as if you're going to own 100% of the business, so you can truly understand the underlying essence of the company and understand what matters and what doesn't matter for the business going forward. From your research, you should be able to identify a rough intrinsic value for the business, and that'll help you know if the business is a true opportunity or not. So with that said, that's it for today's fundamental stock analysis of Lumen Technologies Inc., ticker symbol LUMN. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Lumen with me, and have a great day.